If you're thinking about accounting as your major and/or career, this chapter is going to give you a small taste of what you'll be required to do. As accountants, you will need to demonstrate an understanding of the role that accounting and financial information plays for a business and the business's stakeholders. Recall that business stakeholders include employees, owners, creditors, suppliers, unions, community, investors, and the government for tax purposes. It's important to understand the major purposes of accounting. They include helping managers make well-informed decisions and reporting the financial information about the firm to interested stakeholders. Before we get started on this assignment, this hands-on activity, I want to ensure you understand what accounting means. The textbook definition of accounting is the recording, classifying, summarizing, and interpreting of financial events and transactions in an organization to provide interested parties the needed financial information. The accounting profession is divided into 5 key working areas. They include managerial accounting. In managerial accounting, you provide information and analysis to managers inside an organization. Financial accounting, which provides info and analysis to people, stakeholders outside of the organization, in addition to those inside the organization. Auditing is the job reviewing and evaluating information used to prepare a company's financial statements. The fourth is tax accounting, prepares a company's tax returns and develops tax strategies. And the fifth is governmental and not-for-profit. This is performed for companies that don't generate profit but need to report to government agencies regarding how funds are being used according to an approved budget. Please be sure to review in detail the information in the text, or at minimum the slides on Canvas, to understand not only the definition but what each involves. The method we use to record and summarize accounting data into reports is known as the accounting system. See Figure 17.1 on page 475. We can use the production process from Chapter 9 for the accounting system also. Recall the production process includes inputs, processing, and outputs. Unlike the production process, the inputs, processing, and outputs in the accounting system includes the inputs are the sales documents, purchasing documents, payroll records, travel expenses, and so on, as you can see in this box here. Then we get to the processing, and in the accounting system, the processing includes entries that are made into journals, then transferred into ledgers, and finally summarized and reviewed to compile a trial balance. And then the outputs are the development of financial statements such as the balance sheet, the income statement, the statement of cash flows, which are all prepared for management personnel within the company as well as interested parties outside of the companies. There are other reports that are used for outside of the company, specifically annual reports and so on. This assignment gives you hands-on experience in generating 2 of the 3 financial statements we've talked about. A financial statement is a summary of all the financial transactions that have occurred over a particular period. An accounting year is either a calendar or a fiscal year. A calendar year begins January 1st and ends December 31st. A fiscal year can begin at any date designated by the business. As an example, the Grossmont-Cuyamaca Community College District's fiscal year begins July 1st and ends June 30th of the following year. Financial statements indicate a firm's financial health and stability and are key factors in management decision making. That's why stockholders, the owners of the firm, bondholders, and banks, labor unions, employees, and the Internal Revenue Service are all interested in a firm's financial statements. There are 3 major financial statements used to meet these needs. The 3 major financial statements are the balance sheet, the income statement, and the statement of cash flows. The balance sheet reports the financial position of a business on a particular day in time using the fundamental accounting equation and three major accounts of the balance sheet. The income statement reports revenues, costs, and expenses for a specific period of time, for example, 12 months or the year ending December 31st, 2019. The statement of cash flows reports the cash receipts, that's money coming into the business, and the cash payments, money going out of the business, which are all related to the firm's major activities that include operations, investments, and financing. The differences among the financial statements can best be summarized this way. The balance sheet details what the company owns and owes on a certain day using the fundamental accounting equation. The income statement shows the revenue a firm earned selling its products compared to its costs of selling over a specific period of time. That means the profit or the loss. Finally, the statement of cash flows highlights the difference between cash coming in and cash going out of a business. To fully understand this important financial information, you need to know the purpose of an organization's financial statements. To help with this task, the textbook explains each statement in more detail. Review the Very Vegetarian sample balance sheet on page 483. I have the graphic here for you as well. The balance sheet consists of three accounts. The three major accounts of the balance sheet include the assets, the liabilities, and the owner's equity. The assets are the dollar amounts attached to economic resources owned by a firm. For example, the building, equipment, machinery, office equipment, etc. These can be tangible or intangible. The liabilities are the amounts the firm owes to creditors, bondholders, and others. The owner's equity is the value of everything the firm owns, its assets minus any liabilities. So these are the three components of the fundamental accounting equation. As you can see on the Very Vegetarian sample balance sheet, there are specific accounts under each category, and these are always shown in the very same order. The first category listed is the assets. Again, these are the economic resources owned by a firm. Items can be tangible or intangible and include current assets, fixed assets, intangible assets. When completing the firm's balance sheet, you must list or classify the assets in order of liquidity. What that means is you have to put them on the balance sheet in order of how quickly, how fast they can be converted into cash. So here is a list that shows the classification of assets and liabilities. Again, the assets include the current assets. These are the items that can or will be converted into cash within 1 year. Then we list the fixed assets. These are long-term assets that are relatively permanent, such as land, building, or equipment. And intangible assets, again, long-term assets that have no physical form but do have value, such as patents, trademark, and goodwill. Then we have the list of liabilities by classification. First is what the business owes to others, all of the business's debts. Next is the accounts payable. These are current liabilities a firm owes for merchandise or services that have been purchased on credit. Notes payable are short or long-term liabilities a business promises to pay by a certain date. And bonds payable, which is long-term liabilities the firm must pay back. An important note about depreciation. Fixed assets include depreciation, but you need to remember to deduct or write off the amount on the balance sheet because it is the amount of cash lost on a tangible asset over its estimated useful life. Meanwhile, depreciation is an expense on the income statement. It is a non-cash general expense. Like assets, liabilities are also classified in a specific order, but they are listed based on current and long-term liabilities. Next, let's talk about the owner's equity accounts. The owner's equity is the amount of the business that belongs to the owners minus any liabilities of the owners. The retained earnings are the accumulated earnings from the firm's profitable operations that are reinvested into the business or distributed as dividends to the stockholders. Remember, the accounting equation shows that the value of the things that you own, your assets, minus the amount you owe, your liabilities, should be equal to the equity, what's left over for the owners and the stockholders. Let's talk about the income statement. Again, see page 486 for a graphic that shows an example of the very vegetarian income statement. The formula for the income statement is the revenue minus the cost of goods sold should equal the gross profit, minus operating expenses will equal the net income before taxes, and then minus the taxes equals the net income or loss, the profit or loss of the company. See figure 17.7 as the example that I'm showing you here. Revenue is the monetary value a firm received for goods sold, services rendered, or other payments. The cost of goods sold or manufactured measures the cost of merchandise the firm sells or the cost of the raw materials and supplies it used in producing items for resale. The gross profit or gross margin is how much a firm earned by buying or making and selling the merchandise. The cost of goods sold, it makes sense to compare how much a business earned by selling merchandise and how much it spent to make or buy the merchandise. The cost of goods sold includes the purchase price of the goods needed to make another product, plus the price of any freight charges paid to transport the goods, plus any costs associated with storing the goods. That is what goes under the costs of goods sold. In financial reporting, it doesn't matter when a firm places a particular item in its inventory, but it does matter how an accountant records the cost of the item when the firm sells it. To find out why, read the Spotlight on Small Business box about 2 different inventory valuation methods in your textbook. When we subtract the cost of goods sold from the net sales, we get gross profit or gross margin. The gross profit or gross margin is how much a firm earned by buying or making and selling the merchandise. In a service firm, there may be no cost of goods sold, therefore gross profit could equal net sales. Gross profit does not tell you everything you need to know about the firm's financial performance. To get that, you must also subtract the business's expenses. So another important note about depreciation. First, let's talk a little bit about the operating expenses. The operating expenses are the costs involved in operating a business, such as rent, salaries, supplies, and so on. Depreciation is the systematic write-off of the cost of a tangible asset over its estimated useful life. I've given you a link to click on here that takes you to a website that helps define and helps you to understand a little bit more about depreciation and where it goes and how it's posted on the balance sheet and the income statement. Feel free to click that link and go to that website if you need some additional help. Other operating expenses that appear on an income statement, like depreciation, are a bit more complex. For example, if you have ever heard that a new car depreciates in market value as soon as you drive it off the dealer's lot, the same principle holds true for assets such as equipment and machinery for a business. Again, depreciation is the systematic write-off of the cost of a tangible asset over its estimated useful life. You can go onto the Internal Revenue Service website and find their list of how to calculate the useful life of a piece of equipment. Under accounting rules set by GAAP and the Internal Revenue Service, Companies are permitted to recapture the cost of these assets over time by using depreciation as an operating expense. While depreciation is reported as an expense, it is a non-cash expense for the company, so companies can use it on the income statement as a general expense. However, depreciation is also reported on the balance sheet as a deduction under the fixed assets, so companies can recapture the costs of the asset over time. So, let's talk about this assignment a little bit here. Okay. When we click on the link that will open up the Excel spreadsheet for you, I just wanted to give you a little bit of a heads up here that what's going to show up first is the income statement. So when you open the file, the income statement is going to be there, and as you can see here, the first tab includes the income statement. When you are ready to complete the balance sheet, you'll click on the tab down at the bottom here for the balance sheet, and this is what is going to show up for you. Okay, let's see if I can't get that open for you here. There we go. So I've already opened up my spreadsheet, and as you can see, I have the income statement open. This graphic that I have over to the left here on the slides is available on page 494 in your textbook. I would like to suggest that you maybe print out just this one page or flag it in your textbook or whatever, because this graphic shows you which accounts are going to be listed where. So let's take a look here. Under this heading for the balance sheet accounts, it shows you, it breaks it out into the assets, liabilities, and owner's equity. And then it shows you which accounts are going to fall under. Now this is general. Obviously, for a business, there's going to be a whole lot more, but this is just kind of the simple accounts that we're talking about here, the ones that are used virtually every day. So the first asset account is going to be your cash. Remember, for the assets, you're going to list them in the order in which they can quickly be turned into cash. Obviously, cash is already cash. So that's going to be the first on your assets list. Let's click over here to the balance sheet so we are on the same page here. Okay, so if you notice, the balance sheet accounts are broken into the assets and the liabilities and stockholders' equity or owner's equity. So again, cash, accounts receivable, inventory, investments, equipment, land, buildings, motor vehicles, and goodwill are all considered assets on the balance sheet. Liabilities include accounts payable, notes payable, bonds payable, taxes payable. Are you seeing a same word there at the end? Does that help you understand why it's going under liabilities? It's what we pay out. And then the owner's equity. Now let's take a look at the income statement. And you'll notice that it's broken out into different accounts as well. So we have the revenues, the costs of goods sold, the operating expenses, and then the net profit or income before taxes. We typically deduct how much the income tax expense is going to be in order to determine whether we have a profit or a loss after taxes. So to complete this assignment, you're going to use this matrix and the list of accounts that are shown here on the assignment information. Okay, so the first account and dollar amount that you're going to enter on your balance sheet. Let's go down here a little bit. So let's go to the balance sheet. And as I said, the first item or the account that you're going to list on here is going to be cash, because that's the order in which we place the accounts on the balance sheet. All right, I'm trying to make it so you can see everything here. So let's go ahead, and what you're going to do is you're going to type in the word cash and then tab over to the shadow area, the grayed out area here. And then you're going to go onto the list on the assignment and look for the account called cash, and there it is. Okay, now what you're going to do is you're going to take that dollar amount and enter it onto your spreadsheet. As you can see, I have the spreadsheet already calculating for you, so you don't have to worry about that. Just enter the information. The next account that's going to turn into cash quickly is accounts receivable. So here we're going to look for the accounts receivable. There it is at the very top of our list over there. So we go to our balance sheet and type in accounts receivable and then enter the dollar amount. Oops, sorry about that. 120600. All right. Okay, so if we use our graphic that we have here now, we can also take a look at what there's going to be more that you're going to fill in here. I'm not going to give you the answers for all of it, but again, for fixed assets, fixed assets are listed on here as well. And then the liabilities, the current liabilities, starts out with accounts payable. You'll look on this list to see if there's an account listed for accounts payable, and then you'll enter that information in this section here and the dollar amount, and so on and so forth. Okay, so all of the information that you need is here, and you have to transpose it over to this spreadsheet for the balance sheet. Once you've entered all of that information on your balance sheet, if you've done it correctly, the total down here, the total liabilities and stockholders' equity, is going to be exactly the same as what comes up as the total assets. Remember that accounting equation, okay? Next, the same thing goes for the income statement. So you'll use this part of the graphic for the income statements, and under the revenues you'll find the account name for sales, revenue, and cost of goods sold, and so on and so forth. Fill in the amount, and once you have finished this spreadsheet, you will see whether or not your company has made a profit or a loss. Okay, so I hope this video helps you to understand and how to complete this assignment. Please feel free to contact me if you have any further questions or any issues.